A former IRS auditor just revealed something about 2026 slot machine jackpots that casinos have been quietly preparing for, but players have no idea what's coming. This could cost you thousands if you're not ready. Right now, in 2025, when you hit a jackpot of $1,200 or more on a slot machine, the casino issues you a W-2G form. That's a tax document that goes directly to the IRS, and you're required to report that income on your tax return. That $1,200 threshold has been in place since 1977. For nearly 50 years, that number hasn't changed, but in 2026, everything changes. The threshold is dropping to $600. That means any jackpot of $600 or more will trigger a W-2G form, paperwork, and a direct report to the IRS. And according to former casino compliance officers, this isn't just a small adjustment. This is going to fundamentally change how casual gamblers experience casinos. Let me tell you about Sarah. She's a casual player who visits her local casino maybe once a month. Back in 2024, she hit a $900 jackpot on a Buffalo Diamond machine. She was thrilled. She collected her money, played a little longer, and went home. No paperwork, no tax forms, no complications. Just a nice win that made her night fun. That exact same win in 2026 is going to trigger something she never saw coming. That $900 jackpot will generate a W-2G form with her name and social security number sent directly to the IRS. She'll be required to report it as income on her taxes. And here's the part that almost nobody understands yet. Even if Sarah lost $1,000 total that same night, that $900 still gets reported as taxable income unless she can prove her losses with detailed documentation. The IRS is calling this a modernization effort. They claim the $1,200 threshold is outdated because of inflation. Internal reports suggest the real reason is revenue generation. Slot machines are digital now. Every single transaction is tracked. The infrastructure to report $600 wins already exists inside casino systems. This is purely a policy change, and it's going to catch millions of casual gamblers completely off guard. But the $600 threshold is just the surface level. What's really about to change will affect even people who never hit jackpots. Before I explain what that means, Sama, let me show you the 3 specific ways this rule is going to change your entire casino experience. The first thing that's about to change is something most players haven't even considered: the sheer volume of paperwork you're going to deal with. Right now, based on internal casino data, the average regular slot player hits a jackpot of $1,200 or more about 0.8 times per year. That's less than once annually for most people. It's rare enough that when it happens, the paperwork feels like a minor inconvenience attached to a genuinely exciting win. But according to former casino compliance officers who've analyzed player behavior patterns, that number is about to explode. Under the new $600 threshold, projections indicate that same regular player will trigger between 4 and 6 W-2G forms annually. That's not a small increase. That's a fundamental change in how often you'll be dealing with tax documentation tied to your casino visits. Let me tell you about Frank. He's a retired veteran who plays slots twice a week at his local casino. He's not a high roller. He brings $60 to $80, plays penny or nickel denominations, and treats it as his social time. In 2025, Frank hit a jackpot over $1,200 exactly once. He got his W-2G form, took it to his tax preparer, and it was simple. One form, one entry, done. But when former casino analysts ran Frank's actual play history through projections for 2026, the results were alarming. Based on his betting patterns and the machines he prefers, Frank is going to hit $600 or more, approximately 6 times throughout the year. 6 separate jackpots. 6 separate W-2G forms. 6 separate reports sent directly to the IRS. And here's what makes this particularly problematic for someone like Frank. He lives on a fixed income that includes Social Security. Each of those W-2G forms reports taxable income. Even though Frank's total gambling results for the year might be a net loss, Those 6 jackpots stack up as reported income that could complicate his Social Security income calculations. Most players like Frank have no idea that each W2G goes directly to the IRS, even if you lose everything back the same day. But the paperwork is actually the least of your problems. The second major impact is something casinos are absolutely dreading: the cash flow freeze that's about to hit casino floors. Right now, when you hit a jackpot of $1,200 or more, the machine locks up. A floor attendant has to come verify the win, check your identification, and process a hand pay. That means you sit there waiting while they complete the paperwork and count out your money. Internal casino reports suggest the average hand pay processing time is somewhere between 8 and 12 minutes. That might not sound terrible for a $1,200 win, it feels worth the wait, but now imagine that same process happening for a $650 jackpot. Same lockup, same waiting, same paperwork, same process. Except now it's happening far more frequently across the entire casino floor. Here's the math that has casino managers genuinely worried. A typical mid-sized casino floor might have 2,000 slot machines operating at any given time. Under the current $1,200 threshold, that property processes approximately 40 hand pays on an average day. That's manageable with existing staff. But former casino operations managers who've analyzed player data estimate that number will jump to somewhere between 180 and 250 hand pays daily once the $600 threshold takes effect. That's not a small increase, that's a staffing crisis. And according to one former Vegas Strip casino manager who spoke about internal preparations, the nightmare scenario keeps him up at night. Picture a Saturday evening. The casino is packed. You're already slightly understaffed because weekends are hard to fully cover. Suddenly, you've got machines locking up everywhere, players hitting $650, $700, $850, all requiring hand pays, all requiring staff attention, all creating bottlenecks. Wait times that used to be 8 to 10 minutes are now stretching to 30, 40, even 45 minutes. Players are furious. They're sitting at locked machines, watching other people play and win, while they wait for paperwork to be processed on a jackpot that might not even cover what they've already lost that day. And here's the cruel irony that former casino employees say is going to create the most player frustration. You'll be sitting there trapped at a locked machine, unable to play, unable to leave, waiting for an attendant to process your $600 win, knowing that you've probably fed that same machine $800 or $900 over the past 2 hours. The win doesn't feel like a win anymore. It feels like an interruption. And that's exactly what's going to change the entire psychology of playing slots. But even that isn't the worst part. The third impact is something that tax professionals who specialize in gambling say almost nobody is talking about. And it's going to devastate casual players who don't understand how gambling loss deductions actually work. Here's what you need to understand. Under current tax law, if you receive W-2G forms for gambling winnings, you're allowed to deduct your gambling losses to offset those winnings, but only if you itemize your deductions. That's critical. You must itemize, you cannot take the standard deduction, and also deduct gambling losses. For most Americans, the standard deduction is the better choice. In 2024, the standard deduction for a single filer is $14,600. Or key for married couples filing jointly, it's $29,200. Unless you have enough itemized deductions to exceed those amounts, you're better off taking the standard deduction. Gambling losses only help you if itemizing makes sense in the first place. And according to tax professionals who work extensively with gamblers, estimates indicate that 73% of casual gamblers take the standard deduction. That means their gambling losses are completely worthless for tax purposes. Now let's walk through what that actually means in 2026. Imagine you visit your local casino once or twice a month. You hit $600 or more 6 different times throughout the year. Congratulations! You now have 6 W-2G forms reporting a total of $3,600 in gambling winnings. That $3,600 is reported to the IRS as income. But let's say your total gambling results for the entire year show you actually lost $4,000 overall. You didn't profit, you lost money. But here's the trap. If you take the standard deduction, which most people do, you cannot deduct that $4,000 in losses. The IRS still sees $3,600 in reported gambling income. You're paying taxes on $3,600 of income that represents part of a $4,000 loss. Remember Sarah from the beginning? The woman who hit $900 on Buffalo Diamond? Here's what actually happened when former tax professionals ran her scenario both ways. Sarah is single. She rents an apartment, so no mortgage interest to deduct. She donates maybe $200 a year to charity. She has no major medical expenses. Her itemized deductions total around $3,000. Her standard deduction is $14,600. Taking the standard deduction is obviously the better choice. But in 2026, Sarah hit $600 or more 6 times. Total reported winnings, $3,800. Her actual total gambling results for the year lost $4,200. She's down $400 for the year, but she can't prove her losses because she didn't keep detailed records. So she takes the standard deduction like she always does, and she owes taxes on $3,800 in gambling income. At a 22% marginal tax rate, that's roughly $836 in federal taxes alone, plus whatever her state charges. She lost $400 gambling and now owes over $800 in taxes on that loss. The math is brutal. This is the tax trap that nobody is talking about yet. You could win $3,600 across multiple small jackpots. You could lose $4,000 total, and you could still owe taxes on $3,600 in income because you can't prove your losses without documentation. And even if you could prove them, you're better off taking the standard deduction anyway. According to tax professionals, this scenario is going to blindside thousands of casual players who've never had to think about gambling taxes before. Now, if you think that sounds bad, wait until you hear what casinos are already doing behind the scenes to prepare for this change. Before I reveal what casinos are doing behind the scenes, I need your help. Hit that subscribe button and drop a comment telling me, have you ever won a jackpot that required a W-2G form? What was that experience like? Now here's something that former slot technicians have been revealing in private conversations, and it's information that casinos absolutely do not want becoming public knowledge. Major casino chains have been quietly auditing their floor configurations since late 2024. They've been analyzing data on which specific machines most frequently produce wins in that $600 to $1,200 range. And they're making changes. According to internal reports from former operations managers, high casinos are identifying these machines and either moving them to lower traffic areas of the floor or adjusting the denomination options available on them. Why would they do this? Because every single hand pay costs the casino money. There's the labor cost of staff processing the paperwork. There's the lost revenue from that machine being locked up and unplayable during processing. And there's the player frustration factor that leads to people leaving the property entirely. Casinos have run the projections, and the $600 to $1,200 range is about to become their worst nightmare from an operational standpoint. Remember Sarah's $900 win on Buffalo Diamond? That specific machine at quarter denomination hits $600 or more approximately once every 150 spins at her typical bet level. That's frequent enough to create constant hand pay situations under the new threshold. Former casino floor managers say machines with exactly that profile are being targeted. Some properties are removing quarter denomination options entirely from these games, forcing players down to nickels and dimes where the wins stay smaller. Other casinos are relocating these machines to distant corners of the floor where fewer people will find them. One former casino operations manager said something that should alarm every regular player. He told us, the $600 to $1,200 range is about to become the worst-case scenario for casino operations. We're doing everything legally possible to push players either below $600 or way above $1,500. Anything in that middle range creates paperwork nightmares we don't have staff to handle. But the machine reconfiguration is only one part of how casinos are preparing. The second strategy involves staffing, and it's not what you'd expect. Based on internal casino projections, some properties would need to increase their hand pay staff by 300 to 400% to maintain current service levels under the new threshold. That kind of staffing increase isn't realistic. The labor costs would be astronomical. So, what are they doing instead? Industry insiders say they're implementing automated systems and kiosks that fundamentally change how you receive your money. Let me tell you about Jane. Yup, she worked on a casino floor for 12 years, and she recently described a pilot program that's being tested at an unnamed Midwest casino property right now, in 2025, ahead of the rule change. When players hit $600 or more, they're no longer getting traditional hand pays at the machine. Instead, they're being directed to a kiosk system. You scan your ID at the kiosk. The system verifies your win. Then it issues your payment as a voucher that you must take to the casino cage to redeem. The entire process takes longer than the current hand pay system, but it requires far less staff. You're doing the work yourself. The casino has essentially trained you to view your $700 jackpot as an inconvenience rather than a celebration. You're standing in line at a kiosk. Then you're standing in another line at the cage. Your machine isn't locked up anymore because you've already left it. But your experience has been transformed from receiving congratulations and immediate payment into navigating a bureaucratic process that feels more like renewing a driver's license. And that's exactly what casinos want you to feel. Because of what's happening with loyalty programs, which might be the most cynical preparation of all. Former casino marketing executives report that major chains are redesigning their rewards programs specifically for 2026, and the focus is shifting to something they're calling tax mitigation benefits. Under current loyalty programs, you earn comp dollars, free play, and room offers based on your total coin in. That's how much you've wagered, win or lose. But the new programs being developed are positioning casinos as helping you deal with tax complications. They're offering services to track your losses throughout the year specifically for tax purposes. New player cards that automatically generate detailed win-loss statements. Partnerships with tax preparation services that offer discounted rates to card members. On the surface, this sounds helpful, but here's what these insiders are saying that will shock you. Internal reports suggest this is purely about player retention. Casino executives know that players are going to be furious when they start getting $600 hand pays and stacks of B2G forms. They know people are going to consider just staying home, so they're offering solutions that keep you playing at their property instead of quitting entirely. The dark secret is this: casinos are positioning themselves as your ally in dealing with tax problems, while simultaneously benefiting from the rule change that created those problems in the first place. They're reconfiguring machines to avoid the threshold. They're automating payments to reduce their costs. And they're marketing loss tracking services as though they're doing you a favor. Every single preparation is about protecting casino interests, not yours. But here's where this gets really disturbing. Everything I just told you is what casinos are preparing for. What I am about to tell you is what's going to happen to players who aren't prepared. Tax professionals who work with gamblers have identified 5 specific types of players who are going to be devastated by this change. You're probably one of them. Player type number 1, the retiree on fixed income. This is someone living on Social Security plus maybe a small pension, using slots as their primary entertainment budget. Right now, under the current system, this player might hit $1,200 or more once, maybe twice a year. It's manageable, the tax situation stays simple. But in 2026, this changes dramatically. This same retiree is going to hit $600 or more, potentially once a month or more. Those W2G forms start stacking up. And here's where the real nightmare begins. That additional reported income affects Medicare premiums through something called IRMAA adjustments. Based on analysis from elder care advocates, a retiree with just $600 jackpots throughout the year could see their Medicare Part B premium increase by $800 to $1,200 annually. Let me tell you about Margaret. She's 72 years old, widowed, living on $1,800 a month. She plays slots twice a week as her social outlet. In a projected 2026 scenario, Margaret hits $600 or more 5 times. Total jackpots for the year, $3,200. Her actual total gambling results, lost $3,800. She's down $600 for the year. But those 5 W-2G forms reported $3,200 in income to the IRS and to Social Security. Her Medicare premiums increased. She now owes taxes on $3,200 she can't offset because she takes the standard deduction. Yeah, she won $3,200 in jackpots but lost $3,800 total. And now she owes taxes on $3,200 up plus faces higher Medicare costs for the next year. The math is devastating. She's being punished financially for what was actually a losing year. Player type number 2, the weekend warrior. This is someone who works full-time, visits the casino 2 or 3 times monthly, brings $200 to $300 per visit. Right now, this player type rarely hits $1,200. No tax complications. Life is simple. But former casino analysts estimate this player type will average 8 to 12 W-2G forms annually under the new threshold. Here's the trap. This person makes $65,000 a year at their job. They take the standard deduction because they rent and have minimal itemized deductions. They don't keep gambling records because they've never needed to. In 2026, they hit $600 or more throughout the year. Total reported jackpots, $7,200. That gets added to their adjusted gross income, pushing it from $65,000 to $72,200. That increase can trigger phase-outs of certain tax credits and push them into a higher effective tax rate bracket for some calculations. Let me tell you about Kevin. He's an electrician. Throughout 2026, he won $8,400 across 14 separate jackpots, 14 W-2G forms. His actual total gambling losses for the year, $9,100. He lost $700 overall, but he can't prove it because he never tracked anything. His tax preparer ran the numbers and told him something heartbreaking. You would have been better off never winning at all. Kevin ended up owing over $1,800 in taxes on gambling income that represented a net loss. He paid taxes on money he lost. Player type number 3, the debt recovery player. This is someone who's behind on bills and sees gambling as a potential solution. This is already problematic behavior, but the 2026 rule change makes it catastrophically worse. Right now, this player is chasing big wins. $1,200 or more feels like success, like progress. But in 2026, they start hitting multiple $600 to $900 jackpots. This is where it gets really insidious, according to gambling addiction counselors. The lower threshold creates a false sense of winning more often. Every $600 win triggers dopamine and feels like success. But it also creates tax liability the player isn't thinking about. The cruel cycle begins. They win $600. They owe taxes on it eventually, but don't realize it yet. They can't pay their bills. They return to the casino trying to win enough to cover the taxes they now owe. They lose more. Let me tell you about David. He's a construction worker who was laid off in 2025. Throughout early 2026, he hit 9 jackpots ranging from $600 to $800. Total, $6,300. Sounds like he was winning. But his total gambling losses for that period, $8,200. He was down $1,900 overall. He filed his taxes late in 2026, discovered he owed $1,100 in taxes on those jackpots, couldn't pay it, and penalties started accumulating. By the end of 2026, he owed the IRS $1,850. He was still unemployed. He was deeper in debt than when he started. Documented cases from financial counselors showed this pattern is already emerging in test markets where similar thresholds have been tested. Player type number 4, the high-frequency low roller. This is someone who plays almost daily. Small bets of 50 cents to $1.25 per spin, treating slots as a social hobby. Right now, this player almost never hits $1,200. They fly completely under the tax radar. But in 2026, this player type is going to be absolutely blindsided. Low volatility machines like Buffalo or older video poker variants hit that $600 to $900 range frequently at low denominations. Industry insiders estimate daily players at nickel and quarter denominations will average 15 to 25 W2G forms annually. Think about the paperwork nightmare. A shoebox full of W2G forms. No organized loss tracking because this player never thought they needed it. Tax preparation becomes an expensive ordeal. Let me tell you about Linda. She's a retired teacher who plays Buffalo Gold Quarters daily for 2 to 3 hours. It's her social outlet, her routine. In 2026, she hit $600 or more 23 times throughout the year. 23 separate W2G forms. When tax time arrived in 2027, she brought a shoebox of forms to H and R Block. They told her she needed itemized deductions with documentation to claim her losses. She didn't have documentation. They told her she'd be better off taking the standard deduction anyway based on her overall tax situation. Her reported gambling income, $16,700. Her actual total results, net loss of $2,800. She couldn't prove it. Even if she could prove it, standard deduction was still better. She owed taxes on $16,700. She thought she was being careful by betting small. Nobody told her small bets at high frequency would be the worst possible strategy for 2026. Player type number 5, the out-of-state tourist. This is someone who visits Vegas or Atlantic City once or twice yearly, treating gambling as vacation entertainment. Right now, maybe they hit $1,200 once per trip if they're lucky. One W2G form. Simple. But in 2026, a weekend trip could easily produce 3 jackpots of $600 or more. 3 W2G forms. 3 state tax complications. Here's what former tax preparers are warning about that almost nobody is discussing. Each W2G gets issued in the casino state. That state wants its tax cut. If you live in state A but gamble in state B, you must file a state B non-resident tax return for those jackpots. Technical requirements get complicated fast. You might face potential double taxation that requires credits and special forms to resolve. A basic TurboTax fee of $120 becomes $380 for multi-state returns. Professional preparation costs even more. Let me tell you about Tom and Jennifer. Anniversary trip to Vegas from Ohio. Over one weekend, they hit $650, $750, and $880. Total jackpots, $2,280. Total trip gambling losses, $3,100. They lost $820 on their anniversary trip. But tax time 2027 became a nightmare. They had to file a Nevada non-resident return. Nevada took $180. They tried claiming a credit on their Ohio return. They lost their standard deduction benefit because their itemized deductions still weren't high enough, even with gambling losses included. They paid an accountant $425 to sort it all out. They lost $820 on their anniversary vacation and then paid $425 to file taxes on money they never actually profited from. The entire situation was absurd. Now that you understand who's at risk, let me tell you exactly what you need to do to protect yourself. Action step number 1. Start your loss documentation system right now. The IRS requires specific documentation for gambling losses. You need a daily log, you need receipts, you need casino statements. According to IRS Publication 529, acceptable documentation means contemporaneous records showing date, location, type of gambling, amounts won, amounts lost, and names of other people present. The biggest mistake players are making right now is waiting until January 2026 to start tracking. Tax professionals who specialize in gambling say you need to establish the habit now, test different tracking methods, and build a credible pattern before the rule change hits. There are physical methods like keeping a notebook where you record every session. Write down the date, which casino, what machine you played, how much you started with, how much you left with, and how long you played. There are digital options too. Phone apps specifically designed for gambling logs exist. Apps like Gambling Log or My Vegas Tracker let you input data in real time. Casino-provided player card statements show some information, but they don't capture everything. They show your theoretical loss based on coin in and house edge, but they don't show actual results. Let me tell you about Robert. He started tracking in January 2025 after reading about the coming rule change. 1 year later, he had detailed logs matched against his player card statements and bank records. Throughout that test year, he hit $600 or more 8 times. Total jackpots, $3,800. But his documented losses totaled $4,200. When tax time came, he itemized, Butte used his losses to offset the wins and owed zero gambling tax. His buddy Mike played at the same casino with the same frequency. Mike didn't track anything. Mike hit $600 or more 7 times. Total jackpots, $2,800. Mike's total losses were actually $3,500, but he couldn't prove it. Mike owed taxes on $2,800 of reported income. Same casino, same games, same frequency. One prepared, one didn't. That preparation saved Robert about $650 in taxes. But here's what these tax professionals are saying that's crucial. If you start documenting only in 2026, the IRS may question the sudden appearance of detailed records. Starting now creates a credible pattern. Action step number 2. Evaluate whether you should itemize. This is about understanding the math of standard versus itemized deductions. Standard deduction for 2025 is projected around $14,800 for single filers. For married couples filing jointly, it's around $29,600. The calculation you need to make is whether gambling losses push your total itemized deductions above those thresholds. You must have enough deductions beyond gambling. Mortgage interest counts. Charitable donations count. Medical expenses above a certain percentage of income count. State and local taxes count up to $10,000. Here's a math example. Player A has $12,000 in other itemized deductions plus $5,000 in documented gambling losses. That's $17,000 total. Standard deduction is $14,800. Itemizing saves roughly $600 in taxes at a 25% bracket. But player B has only $3,000 in other itemized deductions plus $5,000 in gambling losses. That's $8,000 total. Standard deduction of $14,800 is clearly better. For player B, tracking gambling losses is worthless for tax purposes. Let me tell you about Carol and Tom, a married couple who both play slots. In 2025, they ran projections both ways with their accountant. They discovered their mortgage interest plus state taxes plus charitable giving totaled $18,000. Their accountant told them, you're close enough to the itemizing threshold that documenting gambling losses makes sense for you. Their 2026 plan is to track everything, itemize, and protect against jackpot taxes. Meanwhile, their friends rent an apartment, have no mortgage, and take the standard deduction. For those friends, tracking gambling losses does nothing. According to tax professionals, roughly 70% of casual gamblers will find that documenting losses doesn't actually help because they can't beat the standard deduction. But you need to know which category you're in before 2026. Action step number 3, change your playing strategy. This is where it gets uncomfortable because what I'm about to suggest goes against everything casinos want you to do. Strategy option A is to avoid the $600 to $1,500 range entirely. Play lower denominations and keep individual wins under $600. You need to calculate which bet levels keep you below the threshold. For example, Buffalo Gold at penny denomination versus quarters produces very different win sizes. Same game, different stakes, completely different tax outcomes. Strategy option B is the opposite. Go bigger and aim for less frequent, larger wins. The logic here is that rather than 10 separate $650 jackpots that create 10 W2G forms, I saw you're better off with one $6,500 jackpot that creates one W2G form. The tax result is identical, but the paperwork and casino hassle drop dramatically. The obvious risk is that this increases volatility and loss potential significantly. Strategy option C is shifting to table games entirely. Table games don't trigger W2G forms until you hit both $600 and 300 to 1 odds ratio. At blackjack, craps, or roulette, that virtually never happens. Let me tell you about James. He was a slots player with a $150 per visit budget. In 2025, he learned about the rule change and switched to blackjack. Same entertainment, same win-loss variance over time, but zero W-2G forms and zero tax complications. He actually prefers it now. The pace is slower, the odds are slightly better, and there are no machine lockups. Former casino consultants who now advise players say the key is deciding what matters to you. Do you want frequent small wins with tax headaches, or are you willing to adjust your approach to avoid complications? But here's what you need to understand. Casinos are tracking these behavioral changes, which brings me to the final thing you need to know. The $600 threshold is just the beginning, according to industry insiders. Let's talk about the bigger pattern that nobody wants you to see. That $1,200 threshold was set in 1977, 48 years ago. It has never been adjusted for inflation, not once. If it had been adjusted, that threshold would be somewhere around $5,400 today. Instead, the IRS is moving it in the opposite direction, down to $600. The projection from former tax policy analysts is alarming. If the IRS can drop the threshold once, they can drop it again. Internal discussions allegedly include future targets of $400, $300, or even $200. This isn't speculation without basis. Digital slot machine systems already track every single win and loss automatically. The infrastructure for reporting $50 jackpots already exists inside casino computer systems. This is purely a policy decision about where to set the reporting line. According to former casino compliance officers, the IRS has allegedly been running pilot data collection programs in tribal casinos, which operate under different reporting rules, specifically to model the impacts of even lower thresholds. This isn't conspiracy theory. This is revenue generation strategy. The IRS knows that casual gamblers won't change their behavior significantly, which means guaranteed tax revenue increases from players who don't understand the system. Imagine 2028 under a potential future scenario. Every slot win over $200 triggers an automatic digital W-2G that gets filed electronically without you even seeing paperwork until tax time arrives. You play slots casually with a $50 to $100 monthly budget. You end the year with 30 W-2G forms totaling $4,800 that you didn't even know about. You can't prove your $5,200 in total losses because you never thought wins that small mattered. Standard deduction is still better than itemizing for your situation. You owe taxes on $4,800 in reported income that actually represents a $400 net loss for the year. That's the world these insiders suggest is coming if this trend continues. What are casinos going to do as this evolves? Prediction number 1. Continued machine configuration changes. You're going to see more penny denomination floors because individual wins stay smaller. Higher frequency jackpot machines that consistently hit the problematic ranges will be removed entirely or relocated to areas where casual players won't find them. Sweet spot games that produce $600 to $900 wins regularly will become rare on casino floors. Prediction number 2. All digital payment systems will become standard. No more hand pays at all, even for $10,000 wins. Everything gets loaded to your player card or mobile app instantly. You never see cash. You never have to think about taxes until April. According to former casino designers, digital-only payments reduce the psychological perception of real money, which increases continued play. It also solves the casino's labor problem with hand pays completely. It's win-win for casinos, lose-lose for players. Prediction number 3. Tax preparation partnerships will expand. Casinos will offer free tax prep services in exchange for detailed loss documentation access and continued play agreements. Play with us, we'll handle your taxes. Industry insiders say this is pure player retention strategy disguised as customer service. What must players understand going forward? The mindset shift is critical. This isn't about beating the system anymore. It's about not getting beaten by the system. The house always had the mathematical edge. Now they have the regulatory edge too. Every digital innovation in casinos, from ticketed systems to player tracking to mobile apps, has been about data collection. The 2026 rule change is just the IRS catching up to data that casinos have been collecting for decades. According to gambling behavior researchers, lowering reporting thresholds won't stop people from gambling. It will just make casual gamblers poorer through tax complications they don't understand. So you have to ask yourself, are you gambling for entertainment with money you can afford to lose? Or are you gambling trying to get ahead financially? The answer matters. If it's entertainment, accept the new reality, track your losses properly, and adjust your expectations. Ron, if you're trying to get ahead financially, and I say this as plainly as possible based on what every expert source has told me, you need to stop now. The math never worked in your favor, and now the tax system is another weight on the scale. Let's review what we've covered. The $600 threshold starts in 2026. Three immediate impacts: paperwork explosion, cash flow freeze on casino floors, and the tax trap that catches people who take standard deductions. Casinos are preparing through machine recalibration, automated payment systems, and loyalty program overhauls. Five player types will be hit hardest: retirees on fixed income, weekend warriors, debt recovery players, high frequency low rollers, and out of state tourists. Three action steps you must take: start documentation systems now, evaluate whether itemizing makes sense for your situation, and consider changing your playing strategy entirely. And the darker future: lower thresholds coming, more automation, more tax complications. Here's what former casino executives have said off the record: the industry is prepared for this change. They've run the models, they've done the analysis. Player volume might drop 3 to 5% initially, but within 6 months, behavior returns to baseline. People keep gambling despite the obstacles because the psychological hooks are that strong. I'm not telling you to stop gambling, I'm telling you to go in with your eyes open. The game changed, most players don't know it yet. You do. Whether you're a once-a-year Vegas tourist or a weekly regular at your local casino, 2026 is going to change your experience. The only question is whether you're ready for it. If this information was valuable, subscribe to this channel. I'll be covering more tax changes, casino strategy adjustments, and insider information as we get closer to 2026. Drop a comment and let me know. Are you going to change your gambling behavior because of this rule? Or are you going to keep playing the same way? Thanks for watching, and remember, the house always wins, but now they've got the IRS helping them do it.